Thank you, Mr. Chairman. Mr. Secretary, I have two issues I'd like you to comment on this morning. The first, many of us place a very large share of the blame for what happened in the secondary mortgage market squarely on the shoulders of the credit rating agencies. Quite a few firms and many pension funds essentially outsourced their own due diligence responsibility to these credit rating agencies. The biggest of them are called nationally recognized statistical rating organizations, that approval bestowed upon them by the SEC. And there seems to be, in reality, no qualifications for that other than that they have a big share of the market. Very often, these particular agencies got it wrong. In many instances, they have conflicts of interest. They got it wrong with complete immunity. And many investors, because they had this apparent government seal of approval, thought it was like the rabbi's seal of being kosher. I don't understand. If some of them aren't really acting as honest brokers, what's the purpose of that title that they have? Is that counterproductive and misleading? And could you tell us something about the administration's intentions on dealing with this issue?
Thank you for raising that. You're right. It was central to the failures, and the failures this time around were much worse than you saw in the failures of ratings in the past, much more damaging. The SEC, I think, released is about to release or just released a set of broad recommendations for trying to address many of the problems you referred to, including reducing the risk that there are conflicts of interest or incentive problems that lead them to or create greater risk of these ratings being wrong in the future. But in addition, we've suggested that we try to eliminate what we call rating dependence in the regulatory capital regime and other parts of the regulatory system. So we're not creating greater incentives for institutions to rely on these ratings. And as the chairman has proposed and many others have considered, we think that a critical part of reform of securitization markets generally is to make sure that people who sell these securities retain some of the risk in them, and that'll help get the incentives right. And of course, as always, we're open to suggestions of how to make sure we strengthen these reforms over the rating agency process.
I'll send you my suggestions. The second issue that I'd like you to address is SIPC. It's been over 9 months since Bernie Madoff discovered that he was a crook and turned himself in. There are 10,000 claims that people who have lost their dignity, their wealth, their security, their homes, their family, and whatever's left. SIPC has contracted out a lot of their work. One of the contractors just lost the computer, or it was stolen or whatever, and 2,200 victims' files are now in the hands of who we don't know. The problem here is of the 10,000 claims that have been filed, only 543 as of July have been paid. That means 95% of the people are just hanging out there, absolutely desperate in most cases. How are investors supposed to have confidence in what's going on if SIPC can't process the claims faster and make these people whole with this insurance policy that people believe that they have?
Congressman, you're right. It's tragic and unfair, and the scope of damage caused by that fraud is just extraordinary. And I welcome a chance to come talk to you or your staff, or have us with the SEC walk you through what we can do to make that process work better. Not just in this case, but
just tell me I want to do that, but just tell me now there's a plan to speed this up somehow. When we couldn't get the checks out to the auto dealers quickly enough, we found a way of doing that. Can we speed this up?
Again, I would be happy to work with the SEC and the other members of the board of SIPC to try to figure out how to do that.
Yield back the balance of my time.